Frankly, when you're short a stock or short a position, you're more like as likely or more likely to be the next buyer of that security than somebody who has no position in the security. I mean, nobody plans, I don't think, to be infinitely short a security.
Let's go boom.
Welcome everyone to another episode of What's the Alternative, where we talk with our managers that are in the field that are managing our alternative investment products to help you better understand these strategies so that you can best use them in your client portfolios. Today we have with us Vince Lorusso with Clough Capital, and he is one of the newest partners on the Vonrian platform. So welcome, Vince.
Hi, Shana. Thanks for having me today. Excited to be here.
I'm excited to have you. I wanted to start off the conversation just talking a little bit about your background and how you kind of ended up where you're at today, and how you started, managing the portfolio that you're managing today.
Yeah, happy to give you the background. I kind of started out with growing up in Philadelphia with a family of lawyers and thinking that I was going to follow in their footsteps. My father's an attorney in Philadelphia today, and I kind of went to school and played as many sports as if I could make the team, I played, and I got involved in a lot of different activities. And I tried to, think about where I would take my college career. And Boston always appealed to me. I wanted to be in the city of Boston, and I thought that'd be a fun place to go to school and learn. But I really went there thinking, eventually I'm going to go to law school. And a lot of the feedback I got from kind of my lawyer family friends were, you don't really need to take pre-law. You could kind of broaden your educational opportunities and get an undergraduate degree and then apply to law school. And that seemed like a plan. I mean, I was pretty young to say that I had kind of high conviction about where this would all take me, but that was my mindset going up to Boston College. So I majored in finance, and kind of lo and behold, I just really enjoyed the subject matter. And it turned out that BC was a strong school in that area, and Boston as a town had a lot of opportunities for students that wanted to learn about finance and investing. So, I kind of think about my education taking me down this path of finance and accounting and economics. And I kind of had a newfound interest in that. And it began with, more formally, I guess, with an internship at State Street Bank. And I often think about kind of the timing of when you're learning about important subjects and what's going on in the industry around you. And it just so happened that in the late 90s, when I was an undergrad, it was a really interesting time to be in finance and investing. Of course, we were in the, what in hindsight was the tech bubble, but, equities were doing extremely well. Job opportunities in finance were kind of, prolific. I mean, it wasn't that difficult, frankly, as a finance major in 1998 to join an investment company. And, at an entry level position, I joined a company that was at the time called New England Funds. So, my transition from undergraduate to the finance industry, kind of began with an internship. And then, like so many folks, it turned into an entry-level position at a firm where I kind of got my foundational skills, I guess, in the industry. I got some of my licensing. I learned about, different investment strategies. And the wonderful thing about joining a company like New England Funds, frankly, I knew so little about it when I joined, but it didn't take very long to realize, gosh, this is part of a much larger organization. It was affiliated at the time with MetLife, and we had these investment partners that were really scattered around the country. And what I came to realize in what ultimately was 6 years with New England Funds and then Natixis Asset Management and mutualfunds.com, kind of different affiliates of this larger entity, I came to realize and appreciate there's a lot of different ways to invest. And as long as you have a rigorous process and discipline and you're transparent and hardworking, you can build investment strategies that cater to kind of a range of needs. One of those affiliates was Loomis Sales in Boston, and they had a really big reputation as a bond manager. They did an exceptional job. It was really fun for me to get to learn that process and think about the way they invested. But then on the other end of the spectrum, we had international managers like Hansberger, based in Florida. Oakmark was affiliated with Natixis and still is, and they're a value equity shop based in Chicago. And so the point being, I think, Shane, as I look back at that decision to join what was ultimately a much larger firm with a lot of different kind of affiliates and partners, I think of it as like a rotation in asset management for me. As somebody coming into the industry at a really interesting time, and obviously watching different firms navigate the tech bubble and kind of the run up in equities that happened earlier in my career. I learned from that one, I have a really keen interest in this industry, and specifically I wanted to join the buy side. I wanted to be more on the security analysis part of the industry. So I was getting a lot of experience in service and marketing and some project management experience. But I really realized, kind of in those first few years, I want to be a portfolio manager. I want to build portfolios. I want to help clients achieve their objectives. I want to have a rigorous process that's repeatable and disciplined. And that really brought me to Clough Capital Partners in 2004. So by now I had been in the industry a little while and, was fortunate enough to get an opportunity to join that firm as they were really at the early stages of growth. So I joined a team of, 7 employees, and we had a couple $100 million in assets under management, but we were, fortunate enough to be kind of on the right side of the tech bubble and beginning a nice runway for growth in terms of strategies and offerings and products and growth at the team level and asset level. And that began really a 16-year stretch that I had at Clough Capital Partners. I then, in 2019, I actually launched an ETF shop with a good friend and a colleague in the industry, and that was called ChangeBridge. So I tried to take some of the learnings I had hopefully acquired at Clough Capital all those years, and I saw a regulatory change that was actively managed ETFs and kind of new opportunities there. And the thought that we had in launching ChangeBridge was that if we could take, again, this rigorous investment process and strategy, be really, thoughtful about portfolio construction and make the strategy available in the active ETF structure, we thought that would create interesting opportunities to launch a business. Lo and behold, a few years later, I rejoined Clough Capital Partners, this time as president and CEO, and I effectively brought the ETFs with me. So I was able to stay kind of in that portfolio management capacity for the strategies we had launched on the New York Stock Exchange, and was then able to bring those back to Clough Capital, effectively rejoin that team that I have worked, so closely with for so many years. I'm really excited to kind of be here today with, hopefully an industry experience set that will help me navigate cycles ahead from an investment and research process, with products that we're really excited about in the active ETF structure, and with a team that I think is just kind of best in class. And we're just so excited to be with Clough Capital today and to have those active ETFs as part of our offerings to clients.
Well, it's really interesting you mentioned Natixis. So a lot of people might not be aware, Natixis was actually one of the early adopters of making liquid alternatives available to the general public. They have been overseeing gateway funds for a long time, which is a very long history of doing covered calls and other options-based strategies very successfully. In fact, fun fact, if you read Harry Markopoulos's SEC letter about Madoff, he actually references the Gateway Fund in that letter as like the proxy for what Madoff should have looked like. And then they also were they have Alpha Simplex under their hood, Andrew Lowe and Alpha Hedge Fund Replication. So they were very early in when the first regulatory changes, you touched on one that made alternative strategies available in ETF form. But prior to that, in 2007, there were regulatory changes that made them more accessible in a mutual fund form. So a lot of people aren't aware that these products have been few and far between until these changes happened, which really has only been in, the last not even 2 decades that we've seen these changes to make these products accessible. And of course, as you also know, they didn't necessarily line up well in terms of market environment for these products to, show what they can really do, especially the '07 ones. Because we went into this full bull market and anything that was hedging underperformed, at least in the eyes of the general investor who's just looking at them in terms of the market, which I think is a good segue into talking a little bit about your experience running like long short hedge funds and what it's like to take that experience and then translate it into an ETF, which has some restrictions. So you can't necessarily take exactly what you were doing. Can you talk a little bit about, those limitations, like how you ran a traditional hedge fund that's long short, and how you had to kind of make changes and adjustments to meet the regulatory framework and the regulatory restrictions of being able to do long short in an ETF?
Yeah, happy to do that, Shane. And you bring up some really interesting points there. And when we talk about the flagship hedge fund, what we refer to as kind of the LP structure at Clough Capital Partners that was launched in March of 2000. So we're actually approaching 25 years since the launch of that flagship hedge fund, and it was very much a hedge fund in the traditional sense. It had a lot of latitude, and still to this day has latitude across asset classes and geographies. So, as an investor, somebody learning the career in the industry at an early age, I mean, it was basically an opportunity to learn about fixed income and equities and some of the different asset classes like futures and derivatives. And we have a lot of tools available to us in that structure. And we try to apply those tools for a fairly specific mandate, to help investors achieve their objectives and from a risk reward basis over cycles. And the interesting thing about the regulatory change, from my perspective, that kind of introduced this opportunity for active managers and hedge fund managers to take advantage of the ETF structure was that there were some limitations. And you kind of alluded to a really important point there for us, Shana, and it was to say, look, we think that alternative strategies can benefit a lot of investors. You have to do some profiling there, and you have to understand your objectives, and you have to read the prospectus and be really kind of careful about the types of strategies you're getting invested in. But the things that really appealed to us from an ETF perspective were the transparency, the liquidity, the tax efficiency of ETFs. So we had to think long and hard about what types of investment strategies are appropriate for that structure. It wasn't the case that you could take any hedge fund, maybe something with leverage or even private equity or derivatives and futures contracts, and make them available on an ETF. I don't think that's necessarily a very good fit for a lot of investors. But what we realize is if you take long, short equity and maybe some derivative capabilities like covered calls, and kind of applying investment strategies that are appropriate for the ETF structure, to us that was going to be the opportunity set, right? So when we launched CBLS, and that's our hedged equity strategy in 2020 on the New York Stock Exchange, when we launched the ETF, we realized we would invest in strategies that also had underlying liquidity profiles that kind of were compatible with the ETF structure. So ETFs have daily liquidity, and we wanted to invest in equities and securities that also offer daily liquidity. We thought that was important to us. That's not necessarily the case with a lot of hedge funds, right? When you talk about quarterly liquidity and kind of lockups and some limitations around access to underlying investments, I think that's appropriate for a lot of hedge fund strategies. But if you want to move into that ETF landscape, I think it's really important to match up some of those liquidity profiles with the liquidity of the ETF structure itself.
Well, I think that you kind of touched on this, but I'd love it if you could just expand on what are actually the restrictions. You talked about liquidity, but leverage and things of that nature. What are some of the restrictions that, when you put it in an ETF format, you have to consider that are quite different than having like a fully able to do pretty much go anywhere and do anything within a hedge fund structure?
Yeah, I think the leverage is an important component of that, Shana. So when you launch an active ETF, it is actually a 40 Act fund. So like a lot of investors are very familiar with the 40 Act landscape, typically as it relates to open-end mutual funds. And actively managed ETF or even a passive ETF, they are also 40 Act funds. So you have the restrictions and limitations that go along with 40 Act funds. So we won't be more than 100% invested with the long book. And, I'll often discuss with allocators that you can have a gross exposure above 100%, right? Because you can have a long book that even at fully invested, call it 100%, you can also have a short book. And if that short book is 20, 30, 40%, your gross exposure goes over 100%. And I think it's appropriate that investors and allocators think about gross exposure because it's not always the case that your long book has an inverse correlation with the short book. So you're taking on a little bit more gross exposure. But I think really importantly, you're not taking leverage with the long book, right? You're only investing up to what is effectively the net asset value of the strategy. Very different from a hedge fund, right? Which can take, 50%, 100%, even, multiples of that in terms of leverage. So, I think that's one of the important considerations. Another consideration is not necessarily things that are overtly restricted. You can have an ETF that uses derivatives or futures or invests in local securities in other markets, but you have to take into consideration the impact that has on the bid-ask spread, right? So there are kind of more esoteric, I think, ETFs that exist and 40 Act funds that will do things within the portfolio that are, capabilities that exist, but what is the liquidity of those? If it's a private equity position, if it has overnight pricing because of the impact of foreign exchange. What does that mean for the bid-ask spread? So the sweet spot that we kind of tried to introduce when we thought about taking our capabilities as an alternative manager, making that available to ETF investors, was to kind of again match that liquidity profile, so that we weren't taking leverage with the long book. All of the securities in the strategies that we manage that are in the ETF structure, they're listed on U.S. exchanges. So some of those considerations around also diversification that apply broadly to 40 Act funds, they apply to our active ETFs as well.
Yeah, and one of the things I always like to bring up is that the fee structures and the way that the regulators make you report your expense ratio is a little deceiving, if you will, in that, you and I both understand that if you're short a security, right, the value of that security is calculated taking into consideration, the cost of shorting, right, and the payment of dividends. That's all calculated in the value of the security and hence the value of the fund. But the regulators require that those same things also be added into the expense ratio. So they're almost double counted in a way. And so I always like to remind advisors that, yes, these types of strategies do tend to be more expensive just because execution of these types of strategies is more expensive. But always look at the prospectus to see what the actual expense ratio is, not what's stated, because the regulatory requirements have things added into that expense ratio that aren't really a reflection of what the true experience is for the investor. Would you say that that's true in your case as well?
I think that's a great point, Shana. Yeah, and I do think the industry has come a long way in terms of understanding that nuance, because alternative strategies, as they become more commonplace, as folks understand and analyze the strategies themselves, I do think of that as kind of like an accounting nuance, that you have a short book, if we use that as an example, the borrowing costs and borrowing expense associated with those short positions get reported as an expense ratio item. I will tell you, as a portfolio manager, I think of those types of expenses as more just a cost of the trade. It's a cost of putting on a position, not unlike the bid-ask spread on a long position that we put into the portfolio. There is a cost associated with the position, and we need to hopefully generate a return above and beyond that cost. I don't think of it as an expense ratio item. It doesn't go to the manager. It simply comes out of the performance of the underlying investment. The other kind of nuance that exists is when you're short a security that pays a dividend. Well, in theory, if you go back to kind of the academic nature of a dividend, it in theory lowers the price of the security by the amount of the dividend. And if a security today made a special dividend of $10, you could reasonably conclude that the stock price would decline by that amount, plus or minus some market adjustments based on kind of their expectations of what that signals and what it means for the capital structure. But effectively, you lower the security price by paying a dividend, which would be a return to somebody who's short that stock, right? You'd be out the dividend, but the stock price would decline. The accounting nuance that I'm referring to here is you have to report that dividend as an expense item. I don't think it's the most transparent way to convey transaction costs versus expense ratio items versus the total return of a strategy. But nonetheless, we obviously operated in a regulatory environment that has certain expectations. And one is that we report those as expense items. The good news is, I think, not just on the allocator side and financial advisors who have become more comfortable kind of thinking through those things, even from a database perspective, I think most or a lot of the databases that I see specific to 40 Act funds and active ETFs, they're able to make some designation between the two, kind of the unitary fee that we would charge, for example, and the costs associated with effectively being an alternative strategy. So it kind of comes out in the wash, but I think you're right to highlight that it's something that folks that are thinking about liquid alternatives, learning about active ETFs, and especially long short equity strategies, you do want to understand that nuance.
You and I have talked about this a little bit, and I'd be remiss not to touch upon it, about how, for you, it was almost like a learning experience when you launched the ETFs, because your initial ETFs, when you launched them, you intended to manage them the way you managed your, the hedge funds stuff in the past. And then quickly learned that, with the limitations around it, that doesn't work so well. So you had to make some changes in the way that you kind of approach managing the funds to be able to, provide investors with a more predictable and understandable way of managing the fund, but also to be able to get good performance. Because some of the things that helped you get good performance in the hedge fund, doesn't actually translate well into the 40x space. Can you talk about the learnings you had in that kind of transition from like, hey, I have this great strategy, I want to do an ETF, to, oh, that great strategy can't actually work as well in an ETF because of XYZ. So we have to adjust and make changes so that we can provide the market what it's looking for in terms of like returns and expectations.
Yeah, it's another good point, Shana. And, I would say over the course of my career, hopefully at Clough Capital and even at Natixis, this kind of, preference for continuous learning and to kind of take the experiences we have in the markets over cycles and with specific products. And we want to continue to build on that and deliver strategies that advisors and allocators find most helpful for them and their clients. So that's ongoing. I think that will continue hopefully throughout my career. But there's a more acute example of that, and you alluded to it. It's with regard to the active ETF, the hedged equity strategy that we manage at Clough Capital, which I would characterize the early period of that strategy, the first couple of years, frankly, as being kind of willing and able to take investment approaches with both the long book and the short book, and even moving the net exposure around in degrees that might be more suitable in that traditional LP hedge fund structure, right? When you're talking about quarterly liquidity or even quarterly disclosure of performance and holdings with a lag. I do think you have a little bit more latitude in that environment, and maybe you're talking about institutional investors and allocators that are kind of willing to look at the performance of hedge funds in aggregate or over longer time periods. I think we were probably allowing the active ETF to be a little bit more volatile across those different lenses. The long book exposures, the concentration of some of our long positions, the idiosyncratic risk within the long book in particular. Trying to generate alpha as we always do with the short book, finding individual securities that we thought would offer us not just relative returns, but absolute returns, and then moving the net exposure around during a very volatile period, right? I mean, we're coming out of that COVID pandemic period, very low interest rates, a lot of stimulus. The learning was even when we had good periods, what I would characterize as kind of within the peer group, kind of, performing in the top decile or having strong periods of performance. If we juxtapose that with periods that were kind of the other end of the spectrum, just too volatile, the drawdowns would be kind of too extreme. I would say over a long enough time horizon, we may be willing to absorb that as asset managers and portfolio managers. But the realization in our conversations with clients and financial advisors was, the active ETF structure and alternative strategy, the preference would be to have a little bit more of a, kind of a lower volatility type of a strategy. So letting the long book at times look a little bit more like the broader market, instead of seeking at every turn to look, very different, to have very low correlation, trying to strike a balance between saying, look, we do want to have high active share, and the nature of our process is to have high active share. We do want to be able to provide lower correlation in returns. But the recognition that if you're too different from the pack at any given point in time, maybe it's over a quarter or a year, it starts to be too difficult for a financial advisor or a client to kind of embrace and endure and manage that volatility over cycles. So again, using that as a learning opportunity when we integrated the ETFs into Clough Capital, re-engaging with the broader team, bringing some of those capabilities and perspectives that we have in the capital markets, I would say we kind of try to revamp or retool the strategy to be a little less volatile on kind of a day-to-day basis. And the results of that effort so far have been, really promising, right? So kind of that willingness to say, we're not going to have, super high active share with the long book and the short book and move the net around. Let's play it more into that alternative equity mindset, the alternative, being kind of a risk-adjusted return. We do want to generate positive alpha and returns over cycles. We do want to do that with less volatility. But if we're too extreme in our willingness to take idiosyncratic bets within the portfolio, that's not didn't feel like the best fit for an active ETF structure. So that was one of the learnings that we took to heart.
Yeah, and you can see in the fund performance, you kind of like when that moment happened and how the changes affected the overall returns. I think right now, what I'd love to get into, just because you are an active ETF manager and you are doing long and short, which is really unique in the way that you see the market. We have had a few days recently where the market's been all over the place. Everybody has an opinion on what the Fed should do because of what the Bank of Japan did. I'd love to get into today, what's the current market environment look like to you, and where do you see opportunities, and what are your thoughts on the current environment, and how things play out over the next 6 to 12 months?
Yeah, it's a great question, Shana. And of course, you're asking it at a very interesting time in the capital markets, right? So we've just had kind of this extended period of, bullish performance from equities, specifically led by a fairly narrow subset of stocks that everybody's quite familiar with. Maybe we call them the Magnificent Seven, but it's kind of this broader large cap technology, AI, semiconductor trade. That's been in place for a while now. We've had this, fairly extreme sell-off. I mean, we've got declines here that are triggering kind of correction levels in some securities, even some very large cap securities were off 25, 30% and more. So, certainly an interesting time to be thinking about where we're positioned. And I think at Clough Capital, we have a few things that we always kind of take to heart. One is to think about investment returns for our clients over cycles. We're not high frequency trading. We're not trying to turn over the themes of the portfolio at a really rapid rate, but we do want to be market aware. So it puts us in this position of saying, look, where are we in the capital market cycle and the economic cycle? And we still land, bullish on equities because we think that the free cash flow generation of a lot of securities and this large cap tech, space in particular is really profound. I mean, it's still probably not as broadly recognized in the market as we think it ultimately will be. And by that, what I mean is, you have this big run up, and if you look at a chart of some of these stocks, they look parabolic. They introduce questions about a tech bubble, and the returns on a year-to-date basis are frankly they're a bit gaudy for some of these securities, and people just, I think, understandably start to opine about what the air pocket looks like beneath these securities. And is this another bubble? I would say when you have the kind of free cash flow generation that these companies have, the valuations look a little bit high, but they don't, to us, look like they're indicative of a bubble. We're not going to have a dramatic shortfall, we don't think, in revenues and free cash flow. The balance sheets are incredibly strong. So as much as folks want to make the parallels to the 99 tech bubble, we think the differences are probably more stark than the parallels right here. So that doesn't preclude us from being ourselves a little bit tactical and trying to implement some of those downside protection tools that I alluded to earlier to try to reduce some of the drawdowns. And we're kind of pleased to say in an environment like this, the short book can really help. And we're able to stay in some of the positions that we like over the longer term, being a little tactical about weightings and price points. But this is that point in a market cycle when active management can really pay benefits to an investor and that short book. So we look at the strategies that we're managing that on kind of a year to date and a 1 year basis and beyond, they've had positive attribution from both the long book and the short book. That's indicative to us of an environment where, again, active managers can add value. We can take a fairly bullish view on equities on a more meaningful time horizon, but do take advantage of the tools we have from a security analysis perspective, from a portfolio construction perspective, to try to mitigate some of the downside. Even having long positions, in some of the more defensive, maybe it's utilities, some maybe consumer staples companies. We own a couple of gold miners right now, so. I don't think it's funny as I analyze a lot of different asset managers and we think about time horizons. I know there's a really kind of viable perspective on this, which is you buy and hold. Maybe it's the Warren Buffett is kind of the obvious example. It's like, look, we're just going to buy these companies, we're going to own them forever. I think that's a very viable way to invest. And then there's kind of the other end of the spectrum is kind of the very tactical momentum following high frequency trading. And I know there are some managers that are really good at that. I would just say we're kind of neither of those things. We sit in a place that says, look, we want to be market aware. We want to be sensitive to our downside. We are risk averse, but we can own companies over a cycle that we feel really good about. And, I do think that within Clough Capital, some of the things that we really adhere to are say, yes, these are actively managed strategies. We're asking investors to give us a broad mandate, that flexibility to move between market caps, risk factors, individual securities that we like. And we try to do that with high conviction, right? So we're not over diversifying. We're not chasing into or crowding into a benchmark. And I think if you put those three things together, I mean, that's kind of the biggest probably learning from my career and our experience at Clough Capital is we want to be active, meaning we want to have high active share. Give us a broad mandate. We'll give you some high conviction investment exposures. And I think the way that we kind of compensate for that degree of latitude is to say, and look, we're going to be very transparent. You know, especially in the ETF structure where you can go onto our website and see all of our holdings in the ETFs on a T+1 basis, meaning basically as of the prior trading day's close. So that's a high degree of transparency, right? You can see actually what we're doing, what we own, but also the accessibility, our willingness and ability to kind of talk about the strategies, what's worked, what hasn't, what do we see in the future, and where are we positioned for market cycles. I feel like that those two offerings have served us well. It helps us deliver, not just hopefully the returns and the product and a ticker symbol, but actually develop relationships with advisors and allocators. We want to be thoughtful about where we are in the markets, what we own, why we own it, and that starts to look more like a partnership than a product. We start to take our experience set and make that available in addition to the strategies.
Yeah, and I think it's really interesting. There's two things you said there that I thought were really interesting. First, what you talked about and the comparisons between today's technology returns and 99 in the late 90s. I argue often about this and debate this mostly because I'm become known as sort of the Nvidia girl because I've been an Nvidia bull for most of my career. And trying to explain to people, if you didn't live through the 90s, like we did, those stocks didn't have any revenue. Like those stocks were just a hope and a dream, right? Like never made money, never had cash flows, had horrible balance sheets. And really, we're taking advantage of a point in time where you didn't need to actually be a good company in order to raise capital by going public, because it was everybody wanted to find the next big thing. And that is not at all what's happening today. Like, while we can debate whether or not something's trading at a premium or a discount, or if it seems a little expensive, we can debate that. But what we can't debate is these are profitable companies with cash flows and solid balance sheets. And I think that is a dramatic difference. And the other thing you touched upon, which maybe we can just explore a little bit, is this idea of the short book. I don't know that everyone truly understands how much of a leap of faith it is for somebody who's been in the traditional hedge fund space to make their shorts known, like very transparently. Like that is something that traditionally people don't like to do because the nature of being short is hard. There's a book that I love called Fooling Some of the People All of the Time by Greenblatt. And it's about like how hard it is to be short. Because like I personally have a friend who was the CEO of a publicly traded company. And if you mentioned somebody who was short his stock, he like got angry. Like, so being transparent and being short is not easy. But in times like this, it can actually add value. And even in good times, there's always stocks that aren't doing well. But being short is really hard because the market goes up more than it goes down. And it's really hard from a psychological perspective because you are seen as evil by most of the companies that you are short, and you have to be transparent about it. So then there are opportunities for folks that obviously, you're not big enough where like the GameStop thing would have affected you in the way that it affected some of the hedge funds. But people having knowledge of your short position and wanting to kind of stick it to you is a thing these days. So can you talk a little bit about like just the nature of like the mindset you have to be to have short positions and kind of some of the psychological as well as technical aspects of that can be difficult?
Yeah, happy to talk about that. And it is interesting. There are so few active managers that have a short book that they disclose publicly. And I can talk about that a little bit. What that means for us kind of empirically or quantitatively is kind of different from what it means for us to do that fundamentally or based on our research. And what I mean by that is, when we think about analyzing securities, and that's at the core of what we're doing, the bulk of the time we're investing in publicly traded equities where we have some perceived intrinsic value for the security, and we look to the market to see whether our estimation of that value is significantly different from what the market ascribes. Do we see a catalyst for value recognition? And And in that regard, being long a position versus being short a position is not that different, right? You have some level of conviction about the value of a company. You think there's a catalyst for some convergence of what we think the value is and what the market thinks. And it's almost pragmatic, I think, to just assume as you analyze hundreds or even over your career thousands of securities, you're going to see some examples of stocks that you think are undervalued and some that are overvalued. Where I would concede kind of the vast majority of the research we do lands in the camp of securities where we don't see a discernible difference in the value that the market ascribes versus what we ascribe. And those are simply passes or securities that you kind of put in a database where you build a knowledge set and maybe someday you have a different opportunity. But most of the work we do lands in no action, but oftentimes we find securities we want to be long, and we do find securities we want to be short. And we think, that is an important part. Kind of, if I step back a little bit from an industry perspective, I think that's an important part of price discovery and valuation analysis. It's that bull bear debate that can reflect itself in an actual position, right? That a client can take, and they can do that to generate alpha. We can hopefully do that to reduce volatility because you're lowering your net exposure. We think we can, over time, generate absolute and relative returns from a short book. So, I guess because I started working for a hedge fund shop so early in my career, I never found anything about that particularly controversial or personal. It was really a valuation exercise that we went down. And if we found a compelling asymmetric risk reward profile, we would put the position on, whether that was long or short. So, that has always been, like I said, kind of foundational for me. I think the really important aspect of this that you introduced, Shane, is what does that look like in a transparent structure like an active ETF? That's when the process for me became a little bit more empirical or quantitative, which is to say, look, we can put on a position given certain assumptions about the percentage of the daily volume that we plan to have, what's the average trading volume of a security, what's the short interest, what are some of the catalysts on the horizon that we see, like an earnings release or other catalysts we might foresee at the macro level. And, so that analysis becomes, I think, more critical when you're talking about transparent, disclosure of a short book. And it probably limits your universe to securities that have a certain amount of liquidity or volume on a daily basis. And you start to think very differently about securities that have a really high short interest. Even before the meme kind of rally that drove a lot of those stocks to probably undefensible valuations. But on the heels of that, certainly that's top of mind for, I think, all investors, right? Is what's the short interest? What's the potential here for kind of a rally on things other than fundamentals? And, that just becomes part of the work we do. I mean, it's great to have a trader who's really qualified at kind of analyzing these things and just being kind of market aware, thinking about the size of our fund relative to liquidity. And, the simple answer is if we see an asymmetric risk reward profile, if we see a short position that we think is going to help our investors, and we think we can both move in and out of the position without disruption, we'd be willing to go down that path. And that's why frankly, we've got a pretty large short book today. We're seeing a lot of those opportunities, despite what I characterized earlier as pretty, kind of bullish views on equities. And we think there's really compelling reasons to own tech names, and some of the security analysis that we do is taking us into biotech and really interesting areas of the market. It's also taking us down the path of short positions. So consumer durables right here, we think are a bit vulnerable. We think the regional banks are going to have a hard time growing. So we see a number of positions that are, we think, going to help our clients. And we make those publicly available. And we know if we have a change of our fundamental view, or if we started to sense that there was some, unusual trading behavior or some technical kind of moves in those securities because of the fact that they have a short interest, we would adjust accordingly. It's part of that active approach with a broad mandate. And, our investors, it's interesting, shorts for, meaningful stretches of the market cycle, shorts tend to be a headwind in terms of absolute performance, right? If you think equities go up over time, and they tend to, well, your short book is going to tend to be a little bit of a drag. But if you can generate alpha, if you can lower the standard deviation, if you can reduce the volatility, and you can contribute positive returns during those periods where the market pulls back, I think introducing a short book alongside a long book, is a really valuable offering in the marketplace. And for too long, they've really been just kind of behind the domain of hedge funds, high minimums, a lack of liquidity, not a lot of transparency. So I think it's kind of a natural evolution of the capital markets. We're going to see more alternative strategies in these daily liquidity, more transparent, more tax efficient structures. And we're thrilled to be, really, candidly at the very early stages of that and kind of
Yeah.
first movers in many ways with our hedged equity ETF.
Well, I think it's interesting. I love that you talked about like the importance of shorts from price discovery. I always like to remind people like shorts have such an important role in market conditions and price discovery, mostly because they serve as sort of a floor, right? Like you can go up forever and never sell out of a position, but if you're short, you at some point have to cover because you just do. And so, we saw in 2008 when they banned shorting of financials, how that led to some free falls because there was no floor. There was nobody to catch the falling knife, if you will, which just led them to fall further as people stayed away from them. And I think, again, to your point, price discovery, you want to have those bull and bear debates to get to the correct price, right?
It's
Of
really important.
that.
Yeah, you bring up some really great points there. I mean, it's funny because a lot of folks will highlight the fact that, the reality and the fact that shorts you can lose more than 100%. And,
Mhm.
that asymmetric risk reward is enough for some folks to say, look, why would I go down that path? And again, not to kind of be blasé about that, but I think the pragmatic perspective we have when we take any position long or short is, if you can lose 100% of your investment in a long position, I think we're no less allergic to that than we are this idea that you can lose more than 100% with a short position. I mean, you can get stopped out, you can have, an acquisition, you can have breaking news, but that kind of happens in both directions. So that asymmetry, I think it's overstated because I think that the psychology of that is really disconcerting for a lot of folks. But look, if you're managing portfolios as your full-time job with risk parameters in place, with an understanding of news flow and technical moves, and you have to, we can move in and out of positions to protect losses. And I would tell you, we probably do that more often with the long book than we have to with the short book. I mean, it's just a reality of investing is that there are risks, and having that price discovery is really important. I mean, you had mentioned earlier, Shana, one of the CEOs you had highlighted in your career who kind of takes a personal offense maybe to investors that have a short position in the security. There are, a lot of different ways to manage risk. It's like I said earlier, it's not personal for us. It's a valuation analysis. And frankly, when you're short a stock or short a position, you are as likely or more likely to be the next buyer of that security than somebody who has no position in the security. I mean, nobody plans, I don't think, to be infinitely short a security. I mean, occasionally you will find something, where it just feels like, gosh, this is a broken business model with no valuation, and it may go to zero. It may literally go to zero. More often, it's about trying to find the right valuation and trying to capitalize some upside for our investors when we can. And then by virtue of covering a short, you're effectively buying the security, right? You're buying it back in the marketplace. So, it's not easy to kind of put on somebody else's hat and try to assume what you would do. I think if I were a CEO of a company that had an investor out there that was short the stock, I'd be really eager to communicate with them and talk about what's going on in the business and try to convey some confidence in the business model in hopes that that would be the next buyer of your stock. So I know it doesn't always work that way, but again, for us, it's not really a personal, criticism of a management team or even a business model. It's usually for us, it's an assessment about the valuation of the stock. And one more, kind of quick point, I think that price discovery and that work, that fundamental work on short positions is really important. I would even step back again and say, look, as fundamental analysts, it's really important, both long and short. So much of the trading that happens today is passive investing. It's allocations on the basis of oftentimes market cap, or it's quantitative investing and algorithmic investing. I mean, the percentage of trading and valuation work that's really done outside of the fundamental arena, I think leaves a lot of room for fundamental managers to help with price discovery and valuation analysis. And I don't think it's just short. I think it's actually long. I think we're as active fundamental managers, I think we're now in the minority of trading that happens on the New York Stock Exchange and the other big exchanges. So I take that for us, I think of that as an opportunity. But I don't think it's kind of relegated to just shorting stocks anymore.
Well, I completely agree with you. I will die on the hill of shorts are super important and we should respect them and not view them as the devil. And every time somebody comes on and says some guy who's short a stock is just talking his book, and doesn't give the same criticism to the guy who's long doing the same, kind of blows my mind. But I think that's such valuable insights. I think most people don't appreciate how hard it is to be short, as you pointed out. And a long position, you have unlimited upside and limited downside, because the most you can lose is 100%, but you can go up way more than 100%. In the short, it's the exact opposite. Like the most you can gain is 100%, really. And, because the most the stock can do is go to zero, and almost never are you able to follow it all the way down there, because you got to cover at some point in order to actually, realize your positive return. But you have unlimited downside. And so, it's hard to be short. And, if somebody has taken the time to go short, especially in the hedge fund world where they might be levered short, they're doing it for a reason, because more often than not, there's a good reason why they are doing that. So you should probably listen to them. You don't have to agree with them, but you should at least hear them out. That's just my personal philosophy. But I would like to thank you for coming on with me today and kind of talking us through. I think it's really important for our audience to understand sort of some of the nuances of active long short ETFs and what they bring to the market, and how to use them, and sort of, why they are different from their hedge fund counterparts, and sort of how to set expectations. Because I think that as we move more and more, and advisors are more and more considering these types of vehicles, it's important to understand sort of, the limitations and the advantages, if you will. So thank you so much for your time. I really appreciate you being with us, Vince.
This has been a lot of fun, Shana. Thanks for having me.
And thank you, everyone, for joining us today for this episode of What's the Alternative? As always, if you liked what you heard, please like and subscribe. And if you have ideas or particular individuals that you are interested in seeing on the podcast, let us know. We're always open to your feedback. Until next time, thanks so much.
Let's go boom.
The opinions expressed on the What's the Alternative podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or in any specific security. This is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this podcast is no guarantee of future results. The guests featured on this program are participants on Bonrian Capital Management's platform. As such, Bonrian may receive payment for their participation as a platform partner. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed investment professional. Investments are not FDIC insured, nor are they deposits of or guarantees by a bank or any other entity, so they may lose value. Investors should carefully consider investment objectives, risks, charges, and expenses. This and other important information is contained in the fund prospectus and summary prospectuses, which can be obtained from a financial professional and should be read carefully before investing. Statements attributed to an individual represent the opinions of that individual as of the date of the published podcast and do not necessarily reflect the opinions of Bonrian Capital Management or its affiliates. This information is intended to provide educational value, highlight issues, and should not be considered advice, an endorsement, or a recommendation. All Bonrian Capital trademarks mentioned are owned by Bonrian Capital Management, Inc., an affiliated company, or its funds. All other company and product names mentioned are the property of their respective companies.